Today, the great mortgage ripoff. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The ACCC released their final report on the mortgage industry today. And yes, folks, we are being ripped off. The so-called inquiry banks were ANZ, Commonwealth Bank, Macquarie Bank, National Australia Bank and Westpac. So today we look at the main points that the ACCC highlight. We're going to show you, courtesy of the ACCC, how you can save significant money off your mortgage. And it's not really that hard. And by the way, if you value the content we produce, please do consider joining our Patreon program. Here is the link. Or make a donation via PayPal. Again, here is the link so that you can support our ability to continue to make great content. The ACCC says that opaque discretionary pricing causes inefficiency and stifles price competition, because the headline interest rate advertised by inquiry banks and used to attract residential mortgage borrowers are a poor indicator of the interest rate borrowers actually end up paying. The vast majority of borrowers pay substantially less than that relevant headline interest rate, a practice the banks call discounting. In fact, there are two types of discounting offered by residential mortgage lenders: advertised discounts, which are generally published on a lender's website and are relatively easier for borrowers to discover, and discretionary discounts, which are offered by each inquiry bank based on criteria that vary across lenders and over time. The criteria for discretionary discounts are not disclosed to borrowers. Discretionary discounts are offered on a case-by-case basis to individual borrowers, usually after the lender has assessed their application. This adds considerably to the time and effort a prospective borrower must expend to obtain accurate interest rate offers from multiple lenders. The unnecessarily high costs that prospective borrowers incur to discover price information from lenders causes inefficiency. And the lack of transparency in discretionary discounts makes it unnecessarily difficult and more costly for borrowers to discover the best price offers. This adversely impacts borrowers' willingness to shop around, either for a new residential mortgage or when they are contemplating switching their existing residential mortgage to another lender. It is likely a key reason why borrowers do not obtain more than one or two quotes when looking for a residential mortgage, despite this being the most significant financial commitment over many years for most borrowers. At least one inquiry bank appears to be aware of borrower frustration with discretionary pricing. But there is little evidence of any inquiry bank responding to that frustration by moving away from the practice. And more generally, the inquiry banks, particularly the big four banks, lack a strong incentive to reduce the cost that prospective borrowers incur to discover price information, because they profit from the suppression of borrowers' incentives to shop around. New borrowers pay lower interest rates than existing borrowers on average. Existing borrowers who do not actively shop around for a better deal on a regular basis are the main losers from opaque discretionary pricing. They have paid interest rates at the inquiry banks that, depending on the category of residential mortgages, were up to 32 basis points higher on average than those paid by new borrowers as at the 30th of June 2018. An existing borrower with an average size residential mortgage who negotiated to pay the same interest as the average new borrower from the 30th of June 2018 could initially save up to $850 a year in interest, depending on the category of the residential mortgage. For existing borrowers with a larger than average residential mortgage, depending on the category of residential mortgage, they could save even more. Many borrowers, once they've taken out a residential mortgage, do not remain actively engaged in the market. Survey data obtained by at least 3 inquiry banks indicate that since at least 2015, there has consistently been a low likelihood, around 20%, that borrowers would seek to refinance or switch their residential mortgages within the next 12 months. Moreover, for borrowers who are engaged and intend to shop for a better deal, the opaque discretionary pricing practice and unnecessary steps that they must follow to discover prices offered by other lenders is likely to deter some from searching for better deals and others from searching as widely as they otherwise would. As a result, there are many existing borrowers who remain with a lender that does not offer them the best deal and earns higher profits as a result of the loyalty of these borrowers. Lenders do not need to compete vigorously on price to retain the business of such borrowers. Offering lower prices to them is simply giving up margin. And moreover, like the inquiry banks, other banks also appear to be offering significant discounts to new customers, with the result that new borrowers are paying lower interest rates on average than existing borrowers at the same time with the bank. While this finding is limited to the 7 banks in the ACCC sample, they suggest that this is further confirmation of a market-wide practice. And they suggest that many residential mortgage borrowers might achieve significant savings by regularly reviewing the interest rates they are paying, asking their lender for a better rate, switching to a cheaper product at the same lender, or switching residential mortgage providers to take up the best available offers. So that leads us to what borrowers can do to get a better deal. The ACCC observed that there is more intense competition for borrowers who are actively engaged and well informed in their choice of residential mortgages. There are 3 ways that other borrowers can benefit from this. Ask their current lender for a better interest rate and lower fees on their residential mortgage, switch their residential mortgage to a cheaper product with the same lender, or switch lenders. It appears that media attention on banks arising from the Royal Commission, the Productivity Commission's inquiry into competition into financial services, and the ACCC's interim report on residential mortgage pricing prompted some borrowers to review their residential mortgages and consider one or more of the actions above. Despite this, the incidence of borrowers switching to another lender in the year to the 30th of June 2018 was low. Less than 4% of variable rate residential mortgages and just 2% of fixed rate residential mortgages with the inquiry's banks' main brands refinanced to another lender in that year. In comparison, approximately 11% of variable rate residential mortgages with the inquiry banks obtained a reduced interest rate or reduced fees in the year to the 30th of June 2018. And many of these price reductions were the result of retention offers made available by inquiry banks when their borrowers were looking to switch to a new lender, were seeking a better price on their residential mortgage, or the bank believed a borrower may be looking for a new lender. These offers are generally only available for variable rate residential mortgages. So a borrower's willingness to negotiate with their lender has been an important factor in the pricing of their residential mortgage. Not all borrowers may be aware that they can negotiate with their lender on price, either before or after they've established their residential mortgage. Even a 10 basis point reduction in the interest rate paid on the average new residential mortgage will save a borrower thousands of dollars in interest rate over the life of the residential mortgage. Borrowers, therefore, should review their residential mortgage products on a regular basis to ensure that they are getting the best possible price. The consumer data right, the CDR, which comes into effect for residential mortgages with the big 4 banks from the 1st of February 2020, will help borrowers do this. The CDR will give borrowers the right to safely access data about them that is held by their lender and direct this information be transferred to trusted and accredited third parties of their choice. In so doing, the CDR will improve borrowers' access to competitive offerings and new and innovative services. For instance, it will facilitate the ability to compare and switch between residential mortgage products. The ACCC believe that the CDR will encourage competition between lenders, leading not only to better prices for consumers, but also more innovative products and services. So the takeaway is simple. Check your mortgage rate and ask your lender for a better rate, even if you have to threaten to move elsewhere. Meantime, the structural and cultural issues within the banking system run deep and to the disadvantage of consumers. Significant reform will be required to bring fairness to the system. Meantime, punters continue to pay more than they should for their mortgages. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.